Welcome to today's CIC group webinar, which is the first of many. Thank you so much for taking time to join. This is a very exciting series that is aimed at simplifying and explaining health, finances, and insurance for everyday people. To begin with, we shall ask Janet Marangu, who is our PR manager of the group, to start us off with a prayer. Janet.
Good morning and thank you for joining us today. Let's believe and pray. Our Heavenly Father, we thank you for this day. We thank you for your grace. We thank you
Janet,
for...
we cannot hear you.
Grace, can you hear me now?
Now I can hear you. Sorry about that.
Okay, sorry about that. From my end, I can see I'm unmuted. So let us believe and pray. Thank you, God, for today. Thank you for your grace and mercy. Thank you for our customers who have joined us today for this webinar session. We ask that your presence be with us. We ask that this discussion will add value to our clients, oh God, as we desire for them to grow in new levels. We give thanks and praise. In Jesus' name I pray and believe. Amen.
Amen. Thank you so much, Janet. As we continue, please tell us on the chat where you're listening in from. Are you in Nairobi, Amsterdam, Kathmandu, wherever you are? If you're in Eldoret, let us know. It's good to know who we are interacting with. Today is a very interactive session, so the chat is open. Please chat with us. Tell us what you think. Ask your questions there. To start with, my name is Grace Nanga-Macharia. I'm the head of marketing for the group, and I'm your host for this morning. At CIC, we believe that financial literacy is not just our buzzword. It's the foundation of building stronger families, resilient communities, and secure futures. That's why here today, we'll start a real conversation about money, investing, savings, and the freedom that comes with smart planning. Our topic of today, as you may have known from our various invites, is Fire Up Your Financial Future. A powerful look at how we can work towards financial independence and retiring early, also known as the FIRE series. Whether you're starting out in your career, or you're in the midway, or you're towards the end of your career, today's session will give you the insights to plan wisely, invest smartly, and dream boldly. Today, I'm not the star of the moment, even though I'm your host. I have people who are specialists who will be talking to us. So allow me to introduce you to our incredible speakers. We have Muthoni Moore, our moderator of the day. She's the invest lead at CIC Asset Management and is passionate about positive impact from money decisions. She asserts that it's never too late, and today is as good a day as any to start your financial well-being journey. Today, she will moderate a compelling session on financial independence and retiring early. Muthoni, you can switch on your camera so we can see you. Our speaker of the day is James. James Jagge believes that financial freedom is one of life's greatest gifts. He has spent 16 years helping others claim it. As a head of business development at CIC Asset Management, he focuses on turning small everyday choices into lifelong security and independence. Today, James will take you through a powerful journey showing you how you can make money your servant and not your master. Get your notepads ready, mine is, and your questions lined up, and let's light the fire. Over to you, Muthoni.
Wow, thank you, Grace, for such a warm introduction. Good morning, our esteemed audience. Thank you for coming in and tuning in early, and thank you for joining us in our inaugural FIRE webinar series. I am Muthoni, as introduced by Grace, and I am excited about today. So we have a great discussion that is lined up for you today, and I noted on the chat that we have people from all over Africa. We have people from Pretoria, we also have people from Kampala, and of course in Kenya, as far as Meru and Katani. So welcome all and enjoy yourself. I would like to begin with some housekeeping. For starters, we do have a chat segment at the bottom of your screens where you can give in your comments, hopefully compliments and no complaints. And we do also have a Q&A section at the bottom of your screen as well, where you can put in your questions and they will be answered as we go or answered live as we present. I would like to also now begin this session with a question. Kindly put in your responses in the chat section. It's a 3-in-1 question, and the question is: at what age would you like to retire, and how much do you think is enough to retire? So ask again: at what age would you like to retire, and how much do you think is enough to retire? You can kindly put in your comments, in your answers in the chat section, and we can go ahead from there. So, oh, I like the answer there. So age, money is never enough. So that's good. So someone is saying money is never enough. Whatever amount of money will never be enough for her to retire. Thank you, Caroline, for that. So she says age is 50. We also have people as early as 40, $1 million. Great. 50 is another age, 45, 50. So you can see a lot of the age limit is between 40 to 55 for retirement. We're seeing as high as 100 million shillings, 1 million shillings per year for expenditure, 100,000 per month. Well done. 10 million US dollars, 20 million. Great. I love that. We've also seen as high as 250 million. So thank you for your participation. And I think the purpose of this question is just to frame your mind and prepare you for the future to know that retirement is coming, and how can we prepare for that. So I'd like to hand over to our main speaker for the day. James, this is your chance. Thank you.
James, you're muted.
Oh, sorry. Good morning, everyone. As introduced, my name is James Njagi, and it's such a pleasure to have you here today. I'm delighted for us to connect, to have a very candid conversation. I think we know bits and pieces of information, but when we read this together, it helps us in terms of getting a full picture. And today, that's exactly what we want to talk about. So, you'll allow me to start with first a simple truth, and I hope you can see my slide. Okay, yes, perfect. So I'll start with a quick question. If I was to give you an option today, I tell you I'm going to give you 5 cents that doubles every day for the next 30 days, or I give you 1 million cash. What will you take? Just drop a chat in the pot, drop an emoji in the chat. Thumbs up for 1 million shillings, thumbs down for doubling the cents. So I'm saying 5 cents doubling every day for 30 days, or 1 million today. What would you take? I know this sounds very obvious, right? But here's the twist. You see that little 5 cents? It grows into Kenya shillings 26 million by day 30. And guys, that's the power of compounding. That's a conversation that we need to have, because that's a conversation that's going to safeguard our future. And the heart of FIRE, and you've seen that FIRE is financial independence, retire early. At the heart of this, it's all about how you plan yourself. It's all about time, money. It's all about the money that you have working for you, not working against you. And that's how you build financial independence. So essentially, when you talk about financial independence, it's not something that you'll just switch it on and off. It's not, like if you hit a jackpot and then it's happening. It is a journey. It's a climb. You have to go step by step. Now, talking of climbs, let's take a look at what this actually looks like. So there we have a ladder. A ladder where at the bottom we have financial security, regular income, then you get financial independence, and finally to wealth. So imagine this as your financial ladder. At the bottom, we have that financial insecurity. So every month, sometimes we feel like we're juggling a lot. We have so many competing priorities in our life. There's the rent there, there's school fees, many, many things. You know that feeling when you're paid salary, but when you think about it, sometimes your money never meets your bank account. So you have the May salary coming in. By mid-month, you don't have any money in your account. So when you're there, it's a bit stressful. but it's also where the journey begins. So it's okay to be there, but also you need to have a plan in terms of the journey moving to the next level. So the first big climb for you is reaching the regular income. That's the first place that you start. Here we're talking about now that stable paycheck. In terms of your overheads, your bills are covered well. You feel, in a sense, you have some bit of a breathing room because at least you have some money in your pocket. But even here, the ladder is still very shaky because if we have a medical emergency, one big one, you can easily just go back to the initial step. So yes, you are from financial insecurity to regular income, but you're not there yet. Then climb higher and you get to financial independence. This is a place where money starts working for you. This is not just about earning now, it's about growing. You're in a very good place. You are, in a sense, controlling your destiny. At this level, you just don't survive. You're thriving, you're living well. And then at the very top, this is wealth. Wealth is not just money in the bank. Wealth is freedom. It's peace, it's choice. And all of us, we aspire to get to that level. But here's the thing, when you go through all those steps, from financial insecurity to regular income, it demands something of you, of all of us. It demands that we have to make some choices, very hard choices. We have to make some sacrifices. It demands that we have to change our habits. So we need to have a plan and we need to stick to that plan. So today, the plan is just to unpack this journey of financial independence. But even as we do that, I have a quick question for you. Based on this, the ladder, where are you? Where are you standing right now? Are you in financial insecurity? Are you having a regular income? Are you at financial independence, or are you wealthy? Now, another question. I love interacting through questions. Are you rich? If you look at your net worth, do you think you're rich? I know that sounds very simple, but real wealth is trickier than it looks. So when you talk about being wealthy, it's not just about having cash in the bank. Cash is very important, and we know this. Cash keeps the lights on. It puts food on our table. But cash by itself is very, very fragile because it can easily come and go. So if you have cash, but no assets, then you are still broke. But on the flip side, you could have assets again. That's quadrant B. So you have assets. Maybe you have a piece of land, very premium, in a very, in a very posh neighborhood, so to speak. But how fast can you liquidate that piece of land? So yes, assets are good, but assets, if you have an emergency, you may not be able to quickly turn those assets into cash and then use that cash to solve the emergency. So true wealth is when you have both. That's quadrant B. Wealth essentially is when you have cash, because cash gives you flexibility. Let's say there's an opportunity here to buy something, you can quickly get into that opportunity. And then you have assets. Look at assets in terms of long-term income generator. So you have your assets there, you have your piece of land, probably you have a property that gives you rental income, and that can generate income for you as you go along. So what we are saying here, cash and assets are friends. They're actually working together to build your freedom. So you need to have cash, you need to have assets. And when you have that, then you can consider yourself wealthy. So again, based on that thinking, and based on this image, are you really rich? Or just for now you're comfortable? Because I sense most of us, we're just comfortable, but we can really get to the next level. Now, once you balance your wealth correctly, the next question is, can you live without working? Because ideally, when you're wealthy, it means your passive income can actually sustain you in terms of your overheads and anything else that you need. So let's talk about that. Let's talk about financial independence in that context. At its core, financial independence means just one thing. Your money is working harder than you do. That's it. When your money is working harder than you do, then you're financially independent. And this is when your passive income, you have your passive, this is income from things like your investment. I was talking about the rental income. Probably you have a small business somewhere that's generating good income. That's passive income. That's not even from your employment. This is when now that passive income is higher than your living expenses. So you always have extra after you cater for your overheads. And for you to get there, for you to become financially independent, it starts with one thing. You have to start planning. Planning is very, very important. Look at planning as the bridge that moves you from wishing I had this, wishing I had that, to actually winning, to actually having whatever you are wishing for. So you don't stumble into financial independence. You have to design it. And this takes time. It's a step by step. You must be very patient. You must make the right choices for you to get to exactly where you need to get. But again, the most important thing, you must be very clear in terms of what it is that you want. So every investment that you make, every shilling that you are saving, every expense that you're controlling is just one more step to get you there. But now, how do we actually get there? And this is the essence of this conversation today. I know we know about these concepts, we know about them because we live them, but I think what probably sometimes we lack is the tool to help us bridge that gap. And today, that's exactly what we want to discuss about. So how are we going to do this? We're going to use a very simple concept. We're going to talk about 6 essential concepts, very basic. If you will, they are tools that can actually help you build that foundation to financial success. So the first powerful truth, 28,000 days. So the average person lives for 28,000 days. That sounds like a big number, right? Until you live half of it. I'm a man, I can disclose my age. I'm 40 years. I've already done half of that. So I have to be serious, right? Now let's step back and just break down this number so that we can understand it better. So 20,000 days, if you divide by 365, how much is that in years? Just get your calculator and divide 20,000 divided by 365. That should be about what? About 76, 77 years. So what you're saying, in this world, you'll be there for at least 76,000 years on average. But just to make our math simpler and easy to remember, let's round it up to 8 years. Now, those 8 years, let's split them into 4 quadrants. This way, so that can break it down and go deep in terms of the different phases and stages in our life. So the first phase is 0 to 20 years. That's the first life phase. At this stage, we are dependent stage. So here, you depend on your guardians, on your parents. Essentially, here your job is to prepare for the future. So how do you prepare? You of course focus on education. You focus on building values, gaining skills, etc., etc. Then you get the next phase. This is the building phase, 20 to 40 years. Now this is where life gets real, because now you've started a career. There are expectations from your family, if you're married, from your children, your wife, from even your parents. You buy your first car. That's when it becomes sometimes like a competition. My friend bought a car, I need to buy a car as well. My friend bought a home, I need to have a home as well. So essentially here, depending on how you're planning yourself, you are building a foundation. You're laying the foundation for your financial life. Then you go to the next phase. That's between 40 to 60 years. Now this is the peak phase. This one is very, very serious. This is a season of maximization. It's about peak career earnings. If you have a side hustle, now it's running by itself. You're scaling your investments, and that's why you're having this conversation just to know where you can invest your money. So here you have to consolidate your wealth. That's the key thing. And not just consolidation, you're consolidating and you're also protecting your wealth. Then we get to the harvest phase, 60 to 80 years. This is retirement, guys. You have to start leaving the foundation that you've built. Your assets are working. So what you've done here, during especially 20 to 60 years, you've been building assets, building wealth, and from that, it can buy you time, it can give you choices, and it can give you freedom. But here's the interesting thing: you realize between age 0 to 20 and 60 to 80, you're actually not working, right? So in truth, you only have 14,000 days because you're only working from age 20 to age 60. So your window to achieving all your dreams is between age 20 to age 60. And I want to believe most of us are there. So do you feel like you've done enough to get you there? So just to reflect about this, where are you today? Are you still building your foundation? Are you growing your assets? Are you planning for your retirement and your legacy? I think that's important because when we self-introspect about this, then it gives us a sense of where we are and what we need to do to actually get where we need to be. And this is the first step for you when you start to planning. When you start the first step to planning in terms of where you're going, in terms of your life. Now, let's talk about, for you now that we have a sense of this journey and how it looks like, you need to have a strategy in terms of your income, right? Because we've said here the key thing is building wealth. And how do you build wealth? Is by having income. So how is your income strategy? Again, as I said, we're going to make it so basic, so we'll keep it as basic as possible. So largely, when you think about it, we have two types of income. We have a variable income and guaranteed income. Guaranteed income gives you consistent, reliable cash flow. So essentially, this is the target for all of us. Guaranteed income is what will get you passive income. Essentially, actually, guaranteed income is passive income. Variable income, this, on the other hand, for this, you have to work for it. You have to put effort. You have to rely on market condition. You have to monitor your portfolio all the time. So let's just pause there. Is rental income a guaranteed or variable income? Is rental income guaranteed or variable income? One will argue if you have a tenant, it is a guaranteed income. But really, even when you have a tenant, sometimes we have these difficult tenants that they're not paying rent in good time and such. So is it really a guaranteed income? It's debatable. But the thing is, once you lose that tenant, it becomes a variable income. Think about investments in things like fixed deposit with banks. So you get some money, place it in a bank, then you're getting a return of, let's say, 5%. And this money usually fix it. You can fix it for, let's say, 3 months, 6 months, giving you 5% at the end of that period. So is that a guaranteed income or is that a variable income? Again, when the money is fixed, it's guaranteed. But when it matures and you have to reinvest, you might not get the same return. You might get probably even lower return. So the point here is we often think most incomes are guaranteed, but in reality, they may not be. So then the question becomes then, when should you focus on variable income and when should you prioritize guaranteed income, right? We need to know when and how you plan around these incomes. So the thinking is in your younger years, when you're in your 20s, your 30s, your 40s even, you can afford to focus on variable income. Because here you're just hustling, you're growing your wealth aggressively. Even in terms of where you invest, you can go aggressive. But as you age, you get into 50 years and beyond, you want to convert your variable income to guaranteed income. Now here, the key thing is stability. You want certainty, you want peace of mind. So in your younger years, yes, you can go aggressive in terms of your investments, but as you get to your 50s, now you have to, as I said earlier, you need not to consolidate your wealth. And all you want, mostly the one thing that you want is certainty. So what we're saying here, the true asset in old age is actually guaranteed income. So in our life, even as we plan along, ultimately, we need to move towards guaranteed income. That's the most important thing. So the question is, are you building guaranteed income for your future freedom? In terms of investment, when you reflect in terms of where you invested, do you feel like you have guaranteed income? And if not, whatever you invested in, do you feel like it will give you guaranteed income in the later years? Now, let's go deeper. We said today what we try to do as much as possible is self-introspection, because once we understand where we are, then we will make the right decision and the right choices. So, ask yourself today, what's your financial reality? When you pause, you reflect in terms of your P&L, your profit and loss account as a person, what's your financial reality? Are you flying? Are you doing so well? Are you walking or are you crawling? Crawling in the sense that, are you in debt, for example? Now, how's the current income moving you forward? So yes, you have some income. Is it sufficient? Is it really funding your dreams? Or is it just patching leaks every month? Whereby, every month you get some money, you are paying that debt. So you never have something for yourself. Then what are your goals? This is very, very important. What's your short-term, medium-term, and long-term goals? Not exact. And the thing about vague about goals, when you talk about goals, usually we're very vague in terms of the answers. We usually ask ourselves, so you're talking about a goal, and the one thing, for example, about getting that well, we say I want to be rich. So how are you going to get rich? You have to be very clear in terms of your goals, because yes, it's good to wish. When you're wishing, then you turn those wishes into plans, and these plans into action, and that's how now you build wealth there. So it's very important for you to have answers for these questions. But then, as we reflect about these questions, I know we are in different journeys, different parts of journey in our lives. But as you reflect on this question, you realize something very interesting. Life never gives you perfect answers. It never does. So every time you'll get certain major events that come your way, and then you have to deal with them. So more often than not, you're never ready for everything. Even you have a plan in terms of your income. I want to get X amount of income and do well. But then you're not able to get there, and then something happens to you. So let's look at these events, because they'll help us plan even better. And generally, we have 4 key life events. Remember we spoke about the 80 years that we're going to live. So in those 80 years, plus or minus, we'll face 4 major financial moments. And the key is how you prepare for these moments. So I'll quickly just highlight these moments. So the first one is education. And the rule of thumb is plan to save 5% of your earnings to fund your children's education. You know what they say about education is just investing in your future earning power. So 5% of your earnings for education. Then, of course, we have illness. We've been talking about medical emergencies. Life is unpredictable, right? You need a safety net. Always you need a safety net. So the rule of thumb is you need to have 5 times your annual income to help you do this. And usually the logic around this is, sometimes you are sick and it can take long for you to recover. So if you have that sufficient income, it can actually support you as you recover from whichever illness that you have. Then the big one, retirement. You need to save at least 15% of your earnings throughout your working life. So every month you've gotten that salary, please ensure at least 15% of that goes to your retirement. And I'll show you why that's very, very important. And then we have to prepare for death. It's an inevitability, we know. We also have to prepare for this. So get a life cover, and ideally it should worth at least 10 times your annual income. This is very important because I think, God forbid, you leave this world, then you don't want to leave your family, your beneficiaries, your children a burden. You need to leave them a good legacy. And sometimes this life cover actually helps a lot. And we've heard stories about people, after you're promoted to glory, then a check comes, and that's what helps in terms of probably even taking care of things like your mortgage obligation that you left. So this is also very, very important. So if you ignore these 4 life events, you'll still meet them, but you'll meet them unprepared. So we cannot run away from this. We must prepare for this. And remember what they said about if you fail to plan, then you're planning to fail. I've seen there's a poll question. Modoni?
Yes, we have a poll that has been conducted. Thank you for that. Let me share the results about the 4 key events. So we polled and we have interesting insights here. So we do have people who are very prepared. 6% of the audience is very prepared. They have a solid plan. So well done. I think a grand salutation to you. However, 50% of our audience are somewhat prepared. So they have started but need to do more. So again, good congratulations to you. At least you have begun the journey. And then we have 35% who have not prepared at all, and they need to urgently plan. And lastly, we have 8% who do not know where to start. So interesting insights from the poll that we've just taken.
Thank you for that, Modoni. Thank you for that. And not to worry, that's why we're having this conversation. As we said, the first thing is for us to reflect and be clear on where we are. And then based on that, we can make some hard decisions. So let's talk about retirement then. This is a very interesting topic for us. Now, remember what we said, you're going to live on average 8 years. So during these 8 years, probably let's assume you start working at age 25. You finish school, you get your first job at age 25, then you retire at age 60. Those are about how many years of employment? That's 60 minus 25, 35 years of employment, or even running your own business. Now, during that period, you are likely to earn about 420 monthly salaries. That's just 35 times 12. So every month you're getting something. So after those 35 years, you've gotten 420 monthly salaries. But remember, we've said that you're retiring at age 80. So between age 60 to 80, you need income. You actually, because you're used to a certain level of life, that's what you want to maintain when you retire. So you need around 240 monthly payments without a job. That's again 80 minus 60 to get 20 years post-retirement times 12. So post-retirement, you need 240. You need 240 payments, monthly payments, to take care of you. But even a bigger question than that, these we can understand, but how much in terms of the quantum value, how much is it that you really need? And we go to another truth, which is very, very important. And I want you please to remember this. Even if you forget everything I said today, please remember this, 75%. This is the income replacement rate. So income replacement rate is essentially, let's assume I retire today at age 60, and I'm earning 100,000 shillings per month. At 75%, it means I'm supposed to have an income, and this income is usually pension, your pension at retirement, worth 75% of my last salary. That's about 75,000 shillings, right? So I've retired today, I was earning 100,000 bob. I'm supposed to have a pension equal to at least 75% of my last salary. And that's supposed to sustain me up to age 80. That should be now my 240 payments. But, unfortunately, the reality for us in Kenya, and this for Kenyans who are working, both informal and informal employment, the income replacement rate, the IRR, is at 5% post-retirement. What does that mean? Again, I've retired age 60, I was earning 100,000 shillings per month. I'm getting a pension equal to 35,000 shillings. So you see there already there's a big gap. I was used to a life where I'm getting 100,000 shillings per month. Then, bam, I retire. The best I can get is 35,000 shillings per month. And that's on average. So meaning some people there are getting much, much less. But let me even show you some more. Kenya, we have about 19 million plus people in employment, but only 4.5 million are saving for their retirement today. And I know, again, if we take a quick poll, we'll see even from the audience, not all people are actually saving for retirement. That's actually about 25% coverage. So what this means in terms of simple numbers, 7 out of every 10 Kenyans are likely to live in old age poverty. That is very, very worrying and very, very scary. There's another statistics also that we got, which was interesting. Close to 40% of Kenyans, they think their children will be their retirement plan. And this is how this works. So, of course, as a parent, you've done your work, you took your child to school, they've done well, you go back to the village, and unfortunately, because many competing priorities in life happened, you did not save enough, so every month your children send you money. Of course, it's good to give back, but also think about it in terms of like cost of living. So sometimes it might not be a sustainable way of doing it, because if, let's say, this child has a financial emergency, then they might not even send you that money. So here the thing is, we individually, we have to plan for this ourselves. We cannot rely on our children or any other beneficiary to help us in terms of this. 82% of retirees in Kenya are actually back to work after they retire. So you get to 60, because you did not build enough wealth, enough savings, you have to start looking for work when you are 60. And I know that's sad. So it's good for us to have this information, these numbers, to help us reflect on them and prepare better in terms of this conversation. So the story here is, the big story here is, you don't retire because you've hit 6 years. You retire because you've built enough. So we have to work around building enough. So you only retire because your money lets you. So if you don't have enough money, then it will be a challenge for you to retire. And as I said earlier, 80% of retirees are actually going back to employment. Now, with that in mind, then how do you build it? How do you build this wealth, these savings, in such a way that when we retire, we're self-sufficient? So allow me to introduce you to a few asset classes that can help you do this. So as you're saying, savings alone cannot secure retirement. So let's think about investment. And I'll start with the first one, equity. Equity is essentially shares in a company. Think of it like owning a piece of, let's say, CIC share, Safaricom share, Equity Bank. Now, the beauty about investing in shares, when they grow, when a company grows, you also grow. So that's one of the key investments that you can consider. Then there's property. Property here, think about things like land, your rental, and such. Now, if you ask most Kenyans, where will you invest if you're given some money right now? The answer will be land, right? Yeah, and land is a great investment. Land is a very valuable asset. It appreciates over time, usually a very good hedge against inflation, because every time inflation goes up, also the prices for land goes up. Land is tangible, and I know this is very important for all of us. You know, that pride in owning a piece of earth makes you feel really, when you're telling people, I have a farm here, I have a farm there, makes you really proud. So what land does, it holds value, but also it locks away your money when you need it most. Because we all know, when you have this medical emergency or any other emergency for that matter, try selling a land, it can take you quite a bit of time. So it's good to own land, but also own other asset classes. Then we have fixed income instruments. Here, think about bonds, government bonds, and treasury bills. So how this works, you lend money to the government, then they pay you. They give you probably like coupon payments every 6 months. So you get an interest from the government. And then at the tail end, when it matures, you get your principal amount. Then we have things like commodities and collectibles. These are essentially just hard assets that often raise in value when everything else feels shaky, things like gold. But I think this probably, you remember that ladder that you're talking about up there where we have wealth? Probably for those guys now, they invest in such things like, paintings and such. And then, of course, we have cash. Cash is money sitting in your bank account or your mobile money wallet. We say what? Cash is king. But until inflation comes and steals its crown. So you have cash there, but as long as every day you have cash in your pocket, no, it's losing in terms of value. So in terms of investing, in terms of the bigger picture, the smartest investor, what they do, they own a mix of these asset classes. You just don't bet on one horse. You spread your investment across, all these different asset classes. And the idea here is to balance risk, think about growth, and also ensure you're protected so that you're not just stuck in one asset classes. So usually say to have the best balanced portfolio, you need to hold all these assets. This is very important. And with this, we'll try to simulate how this can look like through a strategy we call the ABCD investment strategy. So we had an idea in terms of, what asset classes that are there, especially the four main ones. So how can you hold these assets in such a way that they're going to bring you value? So this is a strategy that you can use, and it's easy for you to remember, ABCD investment strategy. A stands for aggressive. Here, think about things that like buying a share, having some cash, and also you can invest in bonds. So remember what we were saying earlier, when you are young, you can actually go aggressive because you have a long time to grow your money, and also you have a long time to recover if the markets don't work in your favor. So when you're young, you lean aggressive. You can invest heavily in equities. So when you think about shares, shares have the highest potential in terms of returns, but also they can be very volatile. They can go up and down. So yes, you go in early, invest in a share, ride that wave, of course, and then you can exit after some years. Then, of course, always you need a bit of cash, not a lot, a bit of cash, because you need liquidity. What liquidity does for you, it allows you to be ready to exercise, to be ready for other opportunities. If you have another investment opportunities, you have some cash with you, it can actually help you in terms of getting there. Then we have B. B is for balanced. Here, I think again, equity, but now not in terms of a portfolio, not a big percentage of a portfolio. Term deposits, cash, treasury bills, and such. So here, the idea is think about steady growth because you are a balanced investor. You're not chasing risk. So you still have that equity to drive a bit of growth in your portfolio. But then you add things like fixed deposit from banks and T-bills. Fixed deposit gives you a fixed rate. So there at least you manage your downside risk. Because already you know you're going to get X% in terms of return. And what this does for you, it stabilizes your portfolio. Then, of course, again, as I said earlier, cash is good because it allows you to, when there are opportunities, you can quickly get into those opportunities. Then C is for cautious. Here now, you're more than balanced. You're cautious. All you want is a return, a stable return. You don't care about it being competitive. It's a stable return over time. So again, here, think about a big chunk of a portfolio in things like the fixed deposit with the rate, with the because they give you a fixed return, and treasury bills from the government, again giving you a fixed return. Then you hold a bit of cash as well. Then lastly, there's defensive. Now here is where now we remember we're talking about that guaranteed income at the tail end now when you're 50 there. The only thing now you care about here is capital preservation. You want to protect what you've built. You're a defensive investor. So here that's when you buy things like bond. You can buy a bond, let's say infrastructure bond for 10 years. And in those 10 years, you're getting those coupons, right? So here is now when you want to be really, really defensive. Now, what we do is we structure for you these portfolios based on your specific risk profile. So this is just a high-level snapshot on how that can look like. But already we have products that can support you in terms of actually having this structure based on your risk profile and based on what phase in life that you are in. As we talk about this, what we are simply talking about is diversification. So diversification is this spreading. You remember the story about land. Land is a very good investment, but also, even as you have land, invest in something like a money market fund. That's part of you diversifying your portfolio. So diversification is very critical so that you're not over-invested in one instrument. And what it does, it may not exponentially increase your return, but it can control your losses. So that you're balanced out. When, let's say, one instrument is not doing well, the other will do well. But even as we talk about diversification, we have to factor inflation. We say inflation is a hidden thief. Look at this journey in terms of inflation evolution in Kenya. In 1970, 5,000 shillings could buy you a car. I don't know if we have people in the audience who are there who had cars in 1970. But in 1970, it could buy you a car. 10 years later, a motorbike. 1990, a bicycle. 2020, probably a pair of sneakers, right? What about 2020? A socks. Now think about 2030. How will inflation evolve over time, and what can it buy you? Inflation is very powerful. So every time we are thinking investment, you're talking about investment, we have to think about inflation. It said inflation is essentially taxation without legislation. So if you're sitting on cash, it's like what? It's like you're holding ice under the sun. If you hold ice under the sun, it will melt away. So what you're saying, yes, we're talking about the emergency part of having a bit of cash to access opportunities, but even that you can put in near liquid instruments. So meaning you can have some cash, put it in something like a money market fund, where when you need to withdraw, you do it within 2 working days. So always remember that inflation is eating away your investments. So always ensure that you put your money somewhere where you're getting a return so that it can be higher than inflation. And on that basis, you actually have a real return. So based on this, do you think your money is working for you? Or is inflation eating all your money? I want to share with you another concept, which I think is important, very simple, but very powerful. So we've said inflation is a silent thief. It's always working against you. But you have a secret weapon to fight back. Remember when we spoke about the 50 cents and the million shillings, the power of compounding. That's how smart money multiplies. So that's your secret weapon against inflation. That's what you need to use, the power of compounding. And here's a simple hack to help you always know if your money is compounding quickly. We call it the rule of 72. So take number 72. Then you invested more. Let's say you put some money in the bank. You're getting a return of, let's say, for example, what? 6%. So you'll say the 72 divided by that 6%, that's the return. And that will show you how long it will take you to double your money. So let me use that real example. So if the rate of return is 6%, we've said 72 is the number that you're going to use. We divide 72 by 6%, you'll get 12 years. Well, that means your money will double in 12 years. So at a return of 6%, your money will double at 12 years. How about if we double that return to 12%? So again, we say 72 divided by 12, that's 6 years. Meaning your money will double in 6 years. So what does it tell you? This rule is very powerful because it's very easy for you. When you're given an investment opportunity, you can quickly have a sense of how fast it can grow, how fast your money will double, how fast you will recover your entire capital. So the higher the returns, the faster the doubling. But when the returns are low, of course, it takes time. As I said earlier, like let's even use something like 2%. You say you're getting 2% in your savings account, divide that by 72, it will take you 36 years to double your money. So with these, even every time you're looking through investment opportunities, you can just quickly review and have a sense of, hey, I'm going to put my money here, lock it in for this long, and then just it take me longer for me to double that money. And then on that basis, you can think of other investment opportunities. So remember what you were saying earlier, let your money work harder so that you don't have to work forever. And with these tools, it can help you get there. So now that we have a sense of, your money working harder for you, we know about inflation, we've touched on compound interest. So how do you start building your multiple streams of income? You need to understand these streams, right? So I'll quickly highlight the 6 streams of income that you can get. I know we've been talking about these assets. We spoke about things like bonds, property, and such. The whole essence of these assets is generate income, because we said the idea is when you retire, you transition from variable income to guaranteed income. And this speaks to that. So you can get dividends. This is income from shares. Remember, we spoke about investing in like a Safaricom share, for example. So income from shares, you can get profits as a shareholder, or even you can get capital gain when you're selling the shares. So that's one of the income that you can get based on the underlying investment. Rent, of course, this we know, rental income. The bit about rental income is more predictable. So you get money every month. But of course, as you said earlier, the challenge is when you lose a tenant, it's not guaranteed you're going to get a tenant that fast. Then we spoke about interest. You put your money in a savings account, you put your money in a money market fund, you're going to get an interest. This is very simple and safe, and it's good for you. Coupon payments, invest in government instruments, your bonds, your treasury bills, you're going to get a coupon from government probably every 6 months. Spoke about capital gains, this is when you sell shares and such. And at the tail end, we have pensions and annuity. What you'll note here, for most of these incomes, as I alluded to earlier, they're not guaranteed income, they're mostly variable income. So pension, annuity, that's the one true guaranteed income. You retire today, you had 10 million shillings, you can go and get a pension equal to, let's say, about 100,000 shillings per month. And the beauty about this, it pays you for the rest of your life. It pays you in perpetuity. So ultimately, even as you invest in the different instruments, think about having part of your savings in a pension or an annuity that will safeguard your life safeguard your finances for life. Now, in conclusion, see, life is a journey. So when you usually starts from flowing from when you're young and free, right? Then you become busy and burdened with so many responsibilities, so many competing priorities, and at the end, you're old and wise. So based on this image, we're saying when you're young, you have all the time and all the energy, but you don't have money. Here we're talking about, you're 0 to 20, 0 to 30. You have all the time, all the energy, but you don't have money. As adults, we are chasing money. We are working hard. We are running faster. But then our time starts slipping away. Then in old age, we have some money and we have time, but we don't have energy. If we don't plan wisely, we risk reaching a point where money, time, and energy, we don't have all of those. They've all run out. And then here is where we get depressed. This is where we get trapped. So what you need to do is you design your life where money, you design a life where money works for you, not against you. We want when you retire, it doesn't feel like it's a restart, but a reward. Remember, we're talking about 82% coming back to work. So the idea is when you retire, you need to reward yourself, but also you need to be energetic. You know you can't stop time, but you can change your ending. And the whole idea is just building a future where money is working for you, not against you. Asanteni sana. Back to you, Modoni.
Great question. Thank you, James, for that. We have a lot of comments and questions in the chat and Q&A, and I'd like to that some for you. So I'll combine three into one. So there's one person who asked earlier on during the presentation, where is the part in enjoyment? So where is enjoyment, and how can I empower my children to become financially independent early in life? And also asked that you talk about self-care with regards to financial planning. So I think you can answer that, and then I'll ask the other.
Thank you for that, Modoni. I like the question about enjoyment, about what hard. So, are you benefiting from the fruits of your labor? It's important for you to of course, also reward yourself in terms of the work. You don't want to have a situation where the only thing that you're doing is leaving this huge wealth for people to inherit. And we've had this in the news. Someone passing. Of course, as you do your planning, you need to leave something there. You need to have a hobby that you can pursue. But what we are saying about the savings part, you have something there. Because later on, you will have that energy to help you in terms of delivering, in terms of even working day to day. So you need to have that savings that can support you there. So I think it's all about a balance. You must balance it out, yes. Yes, have that bit in terms of return, or in terms of having a good time, measured good time, but also save enough to help you during that journey. Then there's a question that came on about how do we impart this on our children. One thing I've learned about our dependents, they learn a lot from us, from our behaviors and how we handle things. So let's say, for example, if even when you're having a conversation, from the get-go, you start telling them about budgeting. Like, yes, I'm giving you this 1,000 shillings, but from this money, then you have to ensure you have it till the end of the month, right? So then how are you going to plan it? So I think for me, if you ask me about children, they need to see it. So they need to see it. So you have to practice for them to see that. Then we spoke about self-care. Now, information is key. Information is very important. So information is very important in terms of self-care. And what we can do in terms of self-care, so this is the one aspect of self-care in terms of your financial wealth, and that's what we're talking about today. But even beyond that, in terms of your health as a person, we can have session to discuss that. But yes, from a financial perspective, it's first you getting that information, and then you start to action. So what we can do even to make this easier for you is having a one-on-one conversation, so that we structure a financial wellness package in the financial context sense that can help you in terms of now, addressing the different challenges, specific challenges that you have in your life. Back to you, Modoni.
Thank you very much for that. I think in the interest of time, let's take two more questions. The one who asked, kindly share and the percentage and age in your ABCD investment strategy. Kindly share sample percentage and age in the ABCD investment strategy. And
Okay.
someone also asked, where do royalties lie in the income streams?
Okay, royalties. So percentage age, what I say about the ABC investment strategy, we are saying when you think about aggressive, it makes sense when you are young. Let me not band it per se, but I think, as I said earlier, between 25 years when you start working to, let's say, age 50, you can be a bit more aggressive. But even as you are aggressive, you're evolving. So at 25, probably you can be heavily invested, for example, in shares. When you get to 30, 35, then you start now diversifying that portfolio. So you have that share, and probably you have a bit of money as well in a fixed deposit, in your bonds. So it evolves as you go along. So it's not like a fixed place. And also it depends with your journey in life, where you are, where in terms of life, where you are in terms of your journey. So some people are early adapters. Probably some people, as per the previous question, actually had these lessons earlier. So that helps them in terms of their planning. So probably even earlier already, they are moving even towards the guaranteed income. So I won't ban them per se, but what we can do again, specifically to you and your specific situation and your income, we can help you in terms of where you fit, right? But generally, yes, when you're young, you can go aggressive, but once you get to the 50s onwards, you really need to protect your income. You need to have that guarantee in terms of your income. Then you spoke about royalties. This is an interesting one in terms of royalties. That's something to think about in terms of where can we place this. But yes, so we spoke about the 5 asset classes that you can invest in. Probably this should be another one, depending on the uptake of these. So in the spectrum again, my view is on these royalties are money is coming in. When you get those monies, can you reinvest them? That's how I look at it. And where do you invest them? Then it comes again, it feeds to the ABCD strategy in terms of depending on now how old you are and how much you've accumulated wealth, then we can help you in terms of where you put that money. So I think that will be my answer to that. Back to you, Mudani.
Thank you very much, James. That was very insightful in terms of the questions you've asked. And compliments to you. I'm looking at the chat. They're saying a lot of claps and things, very insightful information. Well done, wonderful presentation. So congratulations, James. You have been impactful to the people here. I have another question here. Someone asks, did I miss something? The 72 rule. Does 72 represent the amount you have invested? Perhaps you can go to the slide on 72 and elaborate on the number 72 and how 72 came up and what it means.
Okay. Remember, when we are starting, the idea was to simplify these concepts in a way we can always remember quickly. So we have this rule of 72. What it does, it gives you a quick sense of how you can double your money. So what you do, you use the number 72, divide by the return that you're getting from whatever investment that you are invested in. For example, you're invested in what? Money market fund even. It's giving a return of 10%. What it means, and you've invested how much? Let's say 1 million shillings. It means for you to get to 2 million shillings, it will take you 7.2 years. So what you do, you get the 72, divide by 10, you get 7.2 years. And the essence here was just to highlight that when the returns are low, when you have your 6% return, your 2% return, it means it takes you longer for you to double your money. So in the most basics of sense, this helps you in terms of evaluating investment opportunities. You go there, you want to buy, let's say a property for sale, and you're being told it's going to give you a rental yield of 5%, then how long will it take for you to recover the principal that you used? You've wanted to spend 5 million. That's how you do the math. So it's just a basic concept that can help you in terms of quickly assessing investment opportunities. And then from there, you make a quick decision on if it makes financial sense to you, or if you're willing to wait that long for you to recover your principal amount.
Great, thank you. I have a long, interesting question here. An anonymous attendee says, I think saving in a money market fund requires having a good amount of cash to earn significant interest. You also need to be somewhat financially stable, because sometimes I save money and end up withdrawing it a week later. Says, I am 25 and blood tax is really draining me. Any opinion on how I can navigate this through? So it's a long winding question. Do I need to repeat it, or you've gotten the essence of it?
I think I've gotten the essence of it.
Great.
First, I am so proud of, if you allow me to call you young man or young lady, 25 years and you already started, saving and investing. That's actually, most of us started late, but that's very, very impressive. So your question is around the amounts that you're putting in. So let me paint it this way. So I'll use an example of a money market fund. So the minimum amount that you put is 5,000 shillings lump sum initially. Then subsequent top-ups, you're putting 1,000 shillings. And this is ad hoc. You can put it whenever you have the money. Then what we do with this money, we pull the funds together, we go invest it. You remember we spoke about those different types of investment instruments? We go invest in bonds and such, then we get a return. In that portfolio, currently our portfolio is, and I think I have a slide to that effect. Let me just share that. Yes, currently our portfolio is in excess of 87 billion Kenyan shillings, that money market portfolio. So there we have corporates, we have people putting a lot of money, for example, 100 million, Then we have, of course, small investors like me and you, where you're putting 5,000 shillings, 10,000 shillings. These funds are pool invested, then you get a return. Then you use a return of, let's say, for example, 10%. That return is across. Myself, with my 5,000 shillings investment, and an institution with 100 million, all of us will get a 10%. So what this does for you, it pulls your return up, right? Because now, yes, initially without 5,000 shillings, it would have been hard for you even to go, let's say, even buy a share or even buy a government bond, for example. But under this pool, actually, it's pulling a return. And the beauty about this is, by virtue of us having the mass or having the liquidity, we can go and negotiate with banks. For example, we're going to put, let's say, 1 billion shillings, 5 billion shillings with you. Please give us a good rate of return. And that helps in terms of building, enhancing your investment return. Now, remember we spoke about power of compounding? You might think what you're doing now is small. You're putting that 5,000 shillings, 1,000 shillings. But remember, as at the tail end, that speed really picks up really fast. So you might think the investment is not a lot, but by the power of compounding, that amount will grow quite substantially. So don't stress about it. The key thing you've started, the return may not look as amazing right now, but as you continue with that discipline and over time, then we'll get to a place where it'll be amazed in terms of, remember that 26 million, just 5 cents? That's what it will look like later. So just keep the discipline. It's not about the amount, it's about the discipline.
Okay, great. Thank you, James. I think a lot of the questions have also been answered in the Q&A section and part of the chat section. And we'll continue to answer them. So even when we close the webinar, feel free to hold on for a few minutes to see if your questions have not been answered. And I think in the interest of time, would like to begin to close down. And as we end, I'd like to have a quick quiz, and whoever answers it right the first time on the chat. So these are the instructions. The first right answer on the chat will get will get it, and who gets it right will then get the gift. So I hope you are listening to James as he was giving you insights about how to be financially secure and retiring early. So my question is, he said the average human being lives a certain number of days. The average human being lives a certain number of days. What number did he put on the slides? Wow. That was fast. Excellent. So let me just go there quickly. I think we already have a winner on this. A few seconds to just get who was the first correct answer. James Wairoto. So the correct answer, for those who do not know, is 28,000 days. So the average human being lives in 8,000 days, and James told us he's virtually lived half of those. So I'd like to thank each and every one of you for listening and being with us. We will take your contact details, James, and we'll send some merchandise your way. So like I said, the Q&A section is still open. Feel free to just hold on a few minutes after we close to just see your answers being responded to. In terms of our contacts, they are on the slide right there. Feel free to call us, feel free to SMS us, And we are a tech-savvy institution. We do have a website, a very interactive website, and an even better and interactive portal where you can invest in any of our products directly. And importantly, we do have an app, and I must say amongst one of the best apps we have in the country with regard to investments. It's very versatile. Feel free to engage. It's available for both the Apple users and your Android users, and the details are there. Should you want to go the old school way and visit us physically, we are present at CIC Plaza 2 on 8th floor. Allow me to hand this meeting back to Grace for the closure. Thank you very much, James, and thank you very much, our esteemed audience.
Oh, wow. Thank you so much, James. Thank you so much, Modoni. Participants, I think this has been a very powerful interaction. I work here and I was writing notes like you'll never believe. So thank you for joining us today for this powerful session, the Fire Up Your Financial Future webinar series. A big thank you to our fantastic moderator, Modoni Mo, and our insightful speaker, James Jage. Your contribution made today's conversation both inspiring and practical. We've truly been energized by the level of engagement from participants, and they're from everywhere. I've seen someone from Perth, I've seen someone from Nairobi, Kampala, Eldoret, so many places. Your presence shows just how universal the pursuit of financial freedom and early retirement is. I want to retire at 50 million. I saw someone writing that and I completely agreed with. I've always thought of age. I didn't think of the amount. As soon as I'm at 50 million, I'm out. If you missed any part of this session, I've seen very many questions asking if you're going to share the presentation or you want to visit the insights shared. This recording will be available on our YouTube page starting tomorrow. Be sure to subscribe and catch up at your convenience. This is just the beginning of our webinar series. Look out for many more in the future as we continue to demystify insurance, make it simple for everyone, insurance, investments, and walk with you in this journey of financial independence. So until next time, stay curious, stay empowered. Our screens will stay on with our contacts. I'll share the contacts shortly. If you have any more questions, you can contact us on email. You can send an SMS, we'll be there. We have our website, our socials, and you can download the Invest app and start your journey today. Thank you so much.